All right, today we're going on a journey from the absolute bedrock of investing to its bleeding edge. We're going to start with a really powerful, repeatable method that pretty much anyone can use to value a company. And then we'll leap forward to see how AI is completely rewriting the rules of the game. So let's dive right in.
This quote really sets the stage perfectly. It points to this clear line, this evolution, from the old-school principles of valuation, pioneered by legends like Graham and Dodd, all the way to the incredibly complex and powerful world of machine learning. But the core idea? It's always been the same, just turning raw data into actual insight. So here's our game plan. We've split this explainer into two main parts. Part 1 is all about the fundamentals. We're going to build a concrete, quantifiable valuation method you can actually go out and use right away. Then, in Part 2, we'll pull back the curtain to see how the pros, the quants and the AIs, analyze the entire market. You're definitely going to want to stick around for that, because that's where things get wild.
Okay, let's kick off Part 1 and tackle a huge question. How do you figure out what a company is actually worth, away from all the day-to-day market noise and hype? Well, one of the best answers is a powerful tool called the discounted cash flow valuation, or just DCF.
So what exactly is a DCF? Think of it this way. If a company were a fruit tree, the DCF doesn't really care about the price of that tree today. It's about estimating the value of all the fruit that tree is ever going to produce for the rest of its life, and then figuring out what all that future fruit is worth in today's money. It's all about the business's raw cash-generating power.
Now this is where it gets interesting. The DCF is amazing because it forces you to think like a business owner, to focus on the real fundamentals, not just what the market is feeling that day. But its greatest strength is also its biggest weakness. The entire valuation, the whole thing, is built on your assumptions about the future. And if you get those wrong, well, the valuation's going to be wrong too.
All right, so we get the what and the why. Now let's get our hands dirty with the how. I know, this part can look a little intimidating with all its steps, but I promise you it's just a really logical process. We're going to break it right down.
These are the steps, the core recipe. You start by forecasting how much cash the company is going to generate for the next few years. Then, you pick something called a discount rate to account for risk. After that, you calculate a terminal value. That's a stand-in for all the cash flows way out in the future. And finally, you pull all that future money back to what it's worth today to find out what the company is really worth.
And this little formula right here, that's the engine that drives the whole thing. It might look a bit complex, but the idea is actually super simple. This is what lets us take all those future cash flows we dreamed up and translate them into a single number, their value, right here, right now. It's basically a time machine for money.
Okay, so now that you've seen the steps in the formula, let's circle back to a really important point. What do you think is the single biggest hurdle in this entire process?
Exactly. The model is only as good as what you put into it, and the impact of those inputs is just massive. For instance, just tweaking a company's long-term growth assumption from, say, 2% to 3% can swing its final valuation by 20, 30%, or even more. It really all comes down to that old saying, garbage in, garbage out.
And just like that, you now understand a cornerstone of financial valuation. Seriously, that's a huge step. But here's the thing. A DCF values a company in isolation. It's like analyzing a single tree. But what if we want to understand how that tree is affected by the health of the entire forest and the weather patterns all around it? Well, to do that, we need to level up.
Welcome to Part 2. This is where we shift our thinking. We're moving from valuing one company on its own to analyzing assets based on a whole bunch of systemic factors. This is how the quants think about risk and return across the entire market.
Yeah, just one look at this formula tells you we've jumped into the deep end. Instead of just forecasting one company's cash flow, this model tries to explain a stock's return by looking at its relationship to the market as a whole, plus a whole series of other factors. That's what the F1, F2, all the way to Fn are.
And this table shows a classic example, the Fama-French three-factor model. It basically says a stock's return isn't just about the overall market. It's also explained by the size factor, this historical tendency for smaller companies to outperform bigger ones, and the value factor, the tendency for overlooked, cheap stocks to do better than flashy growth stocks. It's all about finding those hidden drivers of return.
And now we take one more giant leap to the absolute cutting edge. If those multi-factor models are about finding the signals that drive returns, then AI is about putting that whole discovery process on steroids at a scale and speed that is just mind-boggling. This timeline just lays it out so clearly.
It started with humans, right? Manually finding factors like size and value. Then, deep learning came along to sift through massive data sets and find complex patterns we could never spot on our own. And now we're in the era of autonomous agents, AI systems that can, for example, read a news report about a factory fire, figure out which companies in the supply chain will be affected, and then build a trading strategy around that insight, all by itself.
And just look at the kind of data these systems are eating up. We have moved so far beyond financial statements. We're talking about this huge world of alternative data. I mean, why would you look at satellite images of a retailer's parking lots? To predict their sales numbers before they're even announced? Why track social media? To see how people really feel about a new phone. It's about finding an edge, a signal, anywhere and everywhere.
This all leads to this idea of a quant agent. The key word here, the game changer, is autonomous. This isn't just a model that spits out a recommendation for a human to look at. No, this is a system that can see new information, decide what to do about it, and then actually act on it, using tools to pull new data or even execute trades. This is a huge shift because it moves the human from being the pilot to being the air traffic controller.
Okay, so we've gone all the way from a fundamental, totally human-driven DCF model to these wild, autonomous AI agents. How on earth do we connect these two worlds? What's the common thread that ties it all together?
And here it is, the common thread. Because at the end of all the data, all the algorithms, all the complexity, markets are still driven by people, and people are driven by psychology. A concept like loss aversion, the simple fact that we feel the pain of a loss about twice as much as we feel the pleasure of an equal gain, that shapes market behavior every single day. At the end of the day, every tool we've talked about, from the simplest DCF to the most complex AI, is designed to do one thing: help us make rational decisions in a world that is often anything but.
And that brings us to the core question for you. We've really looked at two different paths today. The fundamental skill is what we learned back in part 1, the focused, hands-on work of estimating a single company's future. The advanced frontier is what we saw in part 2, automating that entire process across thousands of assets using incredible amounts of data. Both are about finding value. So the only question left is, which skill will you build first?